Good afternoon. Thanks for the opportunity to share some perspectives here on the equity markets, as well as mergers and acquisitions across healthcare broadly, as well as specifically in the ophthalmic space. I thought I'd start first and foremost by providing a little bit of historical context. The chart in front of you depicts the S&P 500 going back to the year 2000. You can see we had a nice bull market between 2002 and 2007. Lasted 61 months, 5 years, had a 14% annualized return, and then we hit the wall. The blue wall here represents the Great Recession from December 07 to 09. Stocks dropped 60%. At the bottom of that, we started the current bull market that we're in today. This has been a 121-month, that's over 10-year bull market. It's delivered 15% returns on an annualized basis. Remember that number, 15%, it'll come back later. And while it's felt a bit like a roller coaster ride, particularly the last 4 or 5 months with the December sell-off and what's turned out to be one of the best first quarters of all time, it's actually been a nice steady climb up and to the right. So we'll dig into a little bit of the details behind this. First of all, this market performance, particularly in Q1, has not been driven by earnings. The red box around the Q4 2018 earnings depicts that 22% of the companies, the highest in the last 8 quarters, 22% of companies missed Wall Street expectations. This was not a good quarter. Those results came out January, February, March, yet stocks, as you just saw on the prior chart, had one of the best quarters on record. So what drove the performance? The blue line on this chart represents the US Treasury, 10-year Treasury bond rate of return. It's generally been moving down and to the right. We overlaid the S&P 500 on that, and you can see that lower interest rates have generally been good for stock returns. The 10-year Treasury today sits at about 2.5%. Doesn't take a financial genius to equate 2.5% return on a US Treasury to the 15% annualized return that we've had in the stock market for the last 10 years. So as we entered December of last year, there was an expectation that the Fed was going to hike rates 2 times in 2019. After some combative tweets, the policy stance changed to patience, and those rate hikes are now off the table. There's even some expectations we could see rate decreases in 2019. That is what has driven the strong Q1 performance, the big rebound from the December trough that we hit to today. So accommodative Fed policy has significant influence over the equity markets. But 10-year bull markets don't come without an awful lot of caution. So one of the monitors out there for investor fear is the volatility index. Every time this index gets above 20, IPOs stop. People don't put, institutional investors don't put capital to work when the volatility index goes above 20. You can see by way of example, September 11th, the attacks on the World Trade Towers, it spiked to 40. There was a lot of fear in the market, and the volatility index picks that up. You can see from 2012 really through today, we have generally been below 20, which is the orange line across the page. We've generally been below that 20 index level. It has been a very good cycle for IPOs, follow-on offerings, and generally good for the stock market. The VIX today, the volatility index, sits at 12.3. So it signals high stability and very little fear in this market. One of the other big concerns in the media today is the risk of a major recession. The last 7 recessions have been preceded by an inverted yield curve. Every one of the last 7 have been preceded by an inverted yield curve. We had to go back to 1965. there are at least 2 data points to suggest you can have an inverted yield curve without a recession. So there are a couple data points, but at least the last 7 have all followed an inversion. An inversion is where the 10-year treasury actually has a lower yield than the 3-year. So 3-month rates are higher than 10-year rates. Let's turn to IPO activity. Talked about volatility being low really since 2012. This has led to really an unprecedented deal cycle. There's a lot of great innovation, great technology, both from BioPharma and Medtech, but we've also had a very good backdrop with the markets increasing, volatility low. It's led to 45 deals per year and over $5 billion of capital that's been invested in life sciences. This is just life sciences IPOs. If you start to peel the onion a little bit, though, on these companies, got biotech or biopharma on the left and medtech on the right, you do start to see some concerning trends. The companies have started to go public earlier. In 2017, 23% of the IPOs were for phase 1 or earlier, 23%. Year to date, almost half of the companies have been phase 1 or earlier. On the medtech side, far fewer deals, but there were no companies that went public in 2017 with less than 20 million of revenue. We've had 1 go public with less than 20, and 2 others in medtech this year that have gone public with 40 or less. So these companies are going public earlier. That is one of those early signs to investors of potential caution, right? If companies go public earlier, business models are less predictable. It's the recipe for missed expectations. Missed expectations lead to stock prices that fall, investors lose money, they're less interested in putting money to work on the next one. So it's something we are all monitoring very cautiously about the quality of the companies that are coming to the market. On the M&A side of the equation, this has been extremely active. Life sciences M&A has been extremely robust, both on the medtech side, 50 to 80 deals per year, and similar numbers on the biopharm side. I think what's most notable is that medtech exits have averaged about $200 million, whereas biopharm has risen, if you see the year to date, average or median deal value, it's been $800 million. I think it's pretty obvious to see why a lot of the venture capital dollars have shifted from medtech to biopharm. Looking at public markets, specifically ophthalmology companies, you can see medtech, since basically going back to the start of 2018, has just been ripping. 50+% increase in stock prices since January of 18 versus biopharm, which is actually fallen 13%. So interesting trends there between the two. Within medtech, a little easier to compare, call it apples to apples, when you are looking at companies that are growing at least 15%, have at least 40 million of revenue. What are investors paying for growth medtech? And you can see by this chart, they are at virtually all-time highs. Investors today are paying almost 10 times forward year revenue for these companies. The long-term average has been closer to 6. The bottom, we get asked by a lot of private equity funds, venture funds, hey, what happens if we take this company public and we hit the next recession immediately after the IPO? You can see the low point. High growth medtech bottomed at 2.9 times forward revenue at the bottom of the Great Recession. On a positive note, it actually rebounded quite quickly. So if you have patience, if you have the capital, you raise enough in the IPO, you can endure that cycle, and within 9 months, stocks basically return to somewhat normalized levels. But from a medtech perspective, this is a great time to be thinking about the public markets with investors, again, looking at the option of investing at 10 times for existing publicly traded companies, or taking a company public at, most of the deals have been pricing at 5 to 6 times. So investors want to play that arbitrage of an IPO versus, what they can buy in the market today. On the M&A side of ophthalmology, as well as the IPOs, You can see M&A has been accelerating. As we look at the concentration of the logos, these are deals over $50 million of enterprise value. We've seen an acceleration of M&A activity in 2019, whereas IPOs in ophthalmology have been generally stable, about 3 per year. So as we turn to things to watch for, as we talk to our research analysts at Piper Jaffray on the Medtech side as well as the BioPharma side, they're very focused on these commercial rollouts of longer-acting anti-VEGFs, commercialization of new lenses and IOLs, the progress of gene editing, gene therapy for inherited retinal diseases, new rapid onset mechanisms for dry eye, commercialization of novel glaucoma treatment combinations. From a macro perspective, equity market and M&A perspective, they're watching, we're watching the earnings and the growth. As we've anniversaried the Tax Reform Act, we're seeing growth in earnings drop precipitously. We saw the Q4 results. More companies are missing earnings. That's going to be, a sign of some wobbliness in the market. We're obviously watching this Fed monetary policy. You saw the effect it had in Q1 with a bad earnings backdrop. It still led to an almost record level of stock price performance. Volatility is always being watched from a new issue standpoint. Access to capital, low-cost debt drives M&A. You can make the math work pretty easily in accretion dilution analyses with 2% money. And we do think where interest rates are today, it's going to accelerate. And we also think that the health and the position, particularly in ophthalmology, of the major consolidators is really kind of poising this market poising 2019 for a great run of M&A. The final thing, though, and the only thing that I can predict with certainty, is that the bull market is going to end. And maybe to quote Warren Buffett, bull markets are like high tides. When the tide goes out, we all get to see who's swimming naked. So enjoy the view.